What's cracking, investors? Another account review here on this Robinhood, 30K to a million challenge that's going on. After I review the accounts, I want to talk about screeners. I want to do some live screening so you can, if you're not familiar, you can figure out how to screen for companies that you like based on preferences that you like as an investor. At first, you may not have any preferences at all, but if you just play around with a screener enough, perhaps you'll find out what meshes best with your investment style. Perhaps you like a more steady style or a fast, growthy, explosive style of investing. And eventually you're going to learn which metrics to look for in the screener to figure out what investments are good for you. So going into the account here. Oh, that's not the account. This is the account. I'm sitting at 180,000 at the moment. Had a 2K day, which is nice. Beating the markets by a little bit. Was up 1.22% versus the market's a little bit under 1%, I think, on the Nasdaq. But anyways, I'll go through all the relative comparison in a minute. First, I'm going to review all the positions which are listed on the right here. You can pause the video player at any moment to try to figure out the exact positions. Let me check out my mic volume. Last time I had a problem, or a couple episodes ago. I think I'm good. So I'm going to scroll through really quickly. You can pause the video player at any moment to try to figure out your exact position. All the information you may need is contained within this little box right here. So feel free to pause. You can see things like Smith & Wesson calls that I've sold yesterday. Already I'm down like $1,000 on that because the underlying actually went up. The stock actually went up. And I didn't sell on time. Not very good at timing apparently. So the Chinese ADRs did okay today, although they should have much further upside to go. We'll see. I only have 4 equity positions at the moment: Apple, Realty Income, Main Street, Paramount, and Smith & Wesson, all of which are in the green except Realty Income, which I'm not too worried about at all. So I had to reduce my position in Realty Income a little bit. If you remember, I had like 800 plus shares. Now I'm down to 427 due to an options event. Let's go to the account first, the investing tab. So total market value is actually less than it was before, but that's not because my account's doing worse. I'm actually doing better. What the difference is the margin level. So you notice here that I'm only at 38.31% margin. You want to double that to figure out how levered you are. So over 74%, 76, over 76, 76.62% levered. So that's not as high as it was a couple of weeks ago. So I'm doing this because I want to reduce the risk. Now that we've had a little bit of a run up, the risk is stacking up to the downside because that's how markets move. They have an up movement and then they have a down movement. They go up and down, right? So I'm preparing for possibly another downside leg, and I'm reducing the margin so I can survive. These are the equities based on total equity. Apple in the largest position with $105,000 plus. Smith & Wesson with 100,000. So those two comprise basically more than 2/3 of the account. Main Street Capital, Realty Income, and Paramount rounding on the bottom at 23,000. Now keep in mind though that 70% of this, 75% of this is actually borrowed money. All right. So it's Robinhood's money. I'm just borrowing them and I'm paying interest on them. Some of you are wondering, well, all right, how much interest are you paying really? And because this is a completely transparent account, we're going to go to the history tab and you'll get to see. This is recent activity. There it is. So Robinhood Gold, $5 up at the top. And Robinhood margin interest at $724.57. So there you go, in case you're wondering about that. I'm not too worried about this number though, even though it might look big, because look at this massive trade, by the way, for $2. You like that? That's huge. I'm not too worried about these $730 because look at this. I saw the call option against Smith and Wesson that's worth about $3,000. So that covers the interest amount that I might be paying for a month. Okay, so let's say 900 of those even, and then I'll get $2,000 profit if nothing happens, basically. So, I'm not too worried about it. As long as I'm selling call options against my positions, then I'm not really concerned about the interest amount that I'm paying, as long as it's reasonable, even though it's gone up in recent days due to the Federal Reserve actions, right? We got rates going up, and margin accounts are very sensitive to those rates, as well as really all savings accounts. Although margin account is not a savings account, but this is not the type of video this is, okay? So let's go back into the investing tab here. What else is there to show? Or the portfolio rather. Okay, yeah, relative performance, all right? So 1 day, 1.2, we're going to compare this to the S&P 500 via the SPY. SPY, just the ticker symbol that represents the S&P 500, which is the top 500 most profitable and largest companies based off of the United States. Anyways, 1.22% today, 3.64% in a week. Good month, 14.35% to the positive. Negative 11.59% on the 3 months. So 3 months, not a very good chart still. Year to date, down 3.1%, which is not horrible. It was a lot worse down in the depths here. That was down 22% almost year to date. What about the March lows that I experienced off of the Chinese ADR crashes? It was down 25% year to date, so that's pretty deep. I was definitely losing to the market big time. And I was also losing the market here at this point. I think that was the new market lows. Anyway, so moving on. Thus the year to date is minus 3.1%. The year over year chart is minus 9%. And the all-time chart, I always have to say that when I show the all-time chart, I started investing in August 28th, somewhere around here. So that's why the chart looks a little bit flat before then, because it didn't have any money. So there you go, 100 and almost 50%. So 1.5 times the money over the course of 4 years or so. All right, S&P 500 via the SPY. Let's see how it did. 1 day, 0.62, so winning there. 1 week, I think it's about even, right? 1 month, definitely winning. I think it was up like 14%. Market's up 6.66, triple sixes. 3 months, definitely losing to the market in the 3 months. I was down 11.5%. Market's down only 2.5. So 9% better. On the 1 year chart, I'm winning. The 1 year, I was down 9%. Market's down 13.78. And on the 5 year chart, definitely winning here. Market's only up 56%, whereas I'm up about 150. So triple the market performance when you compare it in a larger scale frame. So I'm only really losing the 3 month chart at the moment. The main reason for that is the Apple downturn, during like October, September, whenever it happened. That's the main reason that the account is so far down relative to the markets. Other than that, I would have been okay. But such is the situation. All right, next, what we're going to talk about is stock screeners. So I had a request to do some stock screening, so that's what we're going to do. My favorite stock screener to use that is free is stockanalysis.com. They have a screener, so I'm just going to browse around the website, and you'll see me browsing around and see if you like something. So this is what the home screen looks like. You can just start looking for a stock that you like. Maybe you want to search up Tesla. So here it is. It had a really nice day today, 7.82%. But there are many tools here that you see on the left. Let me see if you can see it on the left. Maybe you can't. I can adjust this, no biggie. No big deal. We'll just go like this. There we go. Now you can see the stock screener tab on the left. And we're gonna click on the stock screener. What a screener is basically you input a bunch of criterias, right? Like, let's say price to earnings ratio or enterprise value over free cash flow or whatever, growth over 5 years, debt levels, anything you want. And you click search and it gives you all the possible list of companies with those same criterias. I think the screener only operates with American listed companies. I'm not entirely positive on that. But either way, let's click some filters. So before we even start with the filters, you can do some presets up top. Like if you want to search for the top gainers, for today, you can search top gainers for like this year. Let's see any companies that we know. Target, hospitality, that's not the same as the stores. Sigma Lithium, I guess Lithium Energy is doing all right. A lot of energy related companies. Let's see any company that would be more mainstream. I don't know, I don't really see any. But anyways, so there's a bunch of presets. Like dividend growth is important for a lot of investors because there are a lot of dividend based investments out there. Starbucks is in there. What about monthly dividends? Gladstone, okay. How come this looked different earlier? Anyways, now if you were to add filters of your own, you can choose what you care about, like PE ratio, dividend yield, revenue growth. You can pick right here. Or what you can do is I guess this is how it's done now. Actually, they must have had an update or something. But let's pick all the ones that we want. How about, revenue growth is good. Let's do free cash flow yield. EV over free cash flow. Price to sales ratio is important nowadays, right? How about earnings per growth? No. Revenue growth? No, that's too predictive. We want backwards looking. Anything that's looking in the future, it's just, you never know. So you want kind of like backwards looking criterias. So payout ratio is really important if they have a dividend. I want dividend that's growing. Let's see. I don't know how they measure this. It would be interesting to figure out how they measure buyback yield dilution. I'm actually exploring this as you guys are exploring it with me, because the system used to be a bit different. Like if you go to FinViz's screener, it's quite a bit different. Okay, we want gross profit growth year over year and gross profit growth on 5 year. We want profit margin is pretty important for me. And we want to see how much cash equivalents they have. Total debt. is important for me. Okay, well, let's just start with these. So here we have a bunch of them, and now we get to click like how many of these, what criteria would we want to pick for this, right? So revenue growth, okay, how about over 5%? And you can see the results start shrinking here. So let me see something that's growing at 10% revenue growth, and it just cut it down to like a third of what it was. So how about high revenue growth companies in the last, however many years here? I'm sorry, that's dividend growth. Okay, 5%. Revenue growth, how about over 20%, okay? Total cash, over 1 million. I just want them to have cash. I don't want them to be indebted, let's say. Price to sales ratio, we want that low to be very low. We want that ratio to be very low. So how about under 5 to start? So payout ratio, what a payout ratio is basically how much of the earnings the company is using to pay a dividend. So usually you want that to be like, when it depends on the company heavily in really quite a lot and or the cycle that the company is in. If it's a commodity type of company, then it depends where you are in the cycle. This number can vary quite a bit and is not very instructive. But how about just be safe for now and just pick under 50%? So dividend growth, how about some dividend growth, right? So at least 5% to match inflation. Gross profit growth, okay, a little bit, 5%. Total debt, I mean, actually, we're not going to touch that. How about enterprise value, free cash flow? We want that number to be low. I'm not going to put too many criteria because we only have 19 results right now. I'm just going to put under 30. Buyback yield, I'll just skip that. PE ratio, we don't want something super high. At least I don't want anything that's super high. So we're going to go something very, very well valued. I doubt there's going to be even anything under 20 here. Oh, 13 results, okay. So P ratio under 20. Let's see, gross profit growth, 5 years. Let's go with 20%. All right, we'll lower it down a little bit, 10%. And then profit margin definitely needs to be positive. So over 0, we can narrow it down a little bit. I think profit margin of like 10 to 20% is good, depending on what type of business you're in. Of course, the industry matters quite a bit. Okay, free cash flow yield over 5%. Okay, so there are not many companies that have done this. It looks like we figured out that we narrowed, from thousands of companies to about 8 companies that we're going to work with. So let's take a look at what we got. We have Canadian Natural Resources, okay, so oil and gas, cyclical. Because we have such stringent, criteria for all these companies, there's going to be a lot of cyclicals that look really, really, really good in the short term, and then, they fall off for quite a few years, and they look absolutely terrible. So a bunch of cyclicals probably show up because our criteria are very, very harsh. But I wanted to do this because I can narrow it to show you how you can narrow all these companies down to like very few that perhaps you're looking to shop in. So Diamondback Energy, another energy company here. That's 6 PE ratio. We got Katera Energy, Danos Chemical, Marine. Okay, so one bank in here, and everything else is basically oil and gas exploration. One chemicals company. Let's take a look at this bank. Hopefully they're not foreign. Oops, I did not click on the bank. PEBO, so People's Bank Corp. Listed on the NASDAQ. Let's read a description, okay, before we go any further. People's Bank Corp operates as the holding company for People's Bank that provides commercial and retail banking products and services. The company accepts various deposit products, including demand deposits, blah, 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 real estate, ATM cards, facilities, cashier's checks, telephone, standard stuff. So basically probably like a local bank. All right. And they have brokerage services, okay. Broker dealers, unaffiliated broker dealers, premium finance lending, 135 financial service offices and ATMs, so fairly small, including 100, because they count the ATMs, including 119 full service branches in Ohio. Okay, so 119, so basically a local like Midwest, South, East. I'm sorry, kind of like a East Coast type of Northeast Coast local bank. Founded in 1902, so they have some history. That's nice. All right, so it is an American bank, so that's good, and it's based in the Northeast. Let's take a look at the overview here. Let's see what's going on here. We got a 5 years chart. Oh, interesting dip in 2020, and then it's been cruising. Next thing I'll do on a screener, after looking at some of the statistics real quick, it has a 7.71 PE ratio. The reason why I like the bank here is because banks are not as cyclical as the energy sector. They kind of influence each other a little bit. Obviously, they're tied to the economy and what's going on with rates and whatnot, but they're quite a bit more stable. As you can see, look at the max chart, right? So it doesn't bounce from like $2 to 200 and back down to 2. Okay, so it's pretty stable business. So it was near its lows in 2009. It was about 7.73. Now it's 29.39. Not a very huge difference. So I noticed right away that the dividend is pretty huge, which is probably what keeps this company down in price. They're paying off a lot of their profits to the investors, which is fine. We're going to find out more about that when we go to the financials. People's Bank Corp, huh? Going to the financials, if we go to quarterly, you'll see that, let's see what we're going to see. Revenue bump, for some reason, is very aggressive. Maybe they had some kind of an acquisition. So we're probably going to see some stock dilution if that's the case. So net income here, very good net income. Yep, there's a stock dilution that I was talking about. Whenever you see like a very rapid instant bump in revenue, it probably means some kind of acquisition, and they probably most likely use shares to do it. So you can see that exact thing here. You can see that the share count has been increasing, probably because of these acquisitions. But they try to actually take some of the shares back. If you see that very slight decrease up at the top, that means they're really trying to return money to investors. They want to definitely give them plenty of value. So that's all good. Profit margin is sky high. That's good. Typical for bank. They had a tough operation in 2020. Okay, well, this looks good actually so far. If we go to the statistics, you'll see that they have an enterprise value of 923, market cap of 830. That means they are holding on to some debt. We're going to find out exactly how much when we look at the shortened balance sheet here. And it looks like net cash is negative 92.62 like we predicted. So there you go. They're carrying some debt. It's not really a big deal. They can service it easily. I really like these margins here, right? That's great. So effective tax rate of 20.05. That's okay. Let's take a look at the dividend growth that they may have experienced. So annual dividend payout ratio 38.5. That's fine. Dividend yield pretty large. Dividend growth 5% almost per year. So that's fantastic. And it looks like they haven't had a decrease in dividend since 2013, at least as far as this chart goes. So with this bank, I really like this bank. So if you're looking for a regional bank, there's your idea. There you go. You're welcome. So this is how you use the screener. You figure out criteria that you want. Sometimes, these screeners can really take out like big gems. Sorry, maybe I'm a little tilted. They can sift through data, but they're unforgiving. So a lot of good companies can go through the cracks, and it's not necessarily always a good idea to start with a screener when you're researching companies. But you can. Look, we just came to this company, People's Bancorp, and I think it's a great investment on the surface. Like obviously, if you want to put some money into it, you may want to like dig a lot deeper and figure out, okay, what are the prospects for this bank, what kind of risks it takes, read through their like prospectus and whatnot, and try to figure out some reports, some analyst reports, and read through those and see what kind of the risks of the company are and see if you're okay with that. But it can be a very useful tool to put your money to work in companies that you will feel like you can hold on to. So there you go. That's that. I've been doing some shorts lately, just to try to I don't know, have some fun while while I'm just around up and about. So that's about it. Hopefully you enjoyed this. Leave me a comment below if you have any questions or want to tell me something. That'd be fun. I'll talk to y'all later. Peace out.